This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Global sell-off. Investors rush away from stocks and into gold and treasuries. But how safe are your typically safe havens?
Fresh hope. A major player in Mideast oil production reportedly said OPEC is ready to cooperate on a cut. But how real is a possible deal?
Beat the heat. Stocks that may help you weather this market volatility. All this and more tonight on Nightly Business Report for Thursday, February 11th.
Good evening, everyone, and welcome. Stocks touched multi-year lows today around the globe and here in the U.S. briefly. The selling was heavy and across all sectors. Financials led the way down, not just here in the U.S., where they lost 3%, but significantly in Europe as well. There was a further slide in oil prices, too, and Federal Reserve Chair Janet Yellen was cautious on the economy in Capitol Hill testimony. By the closing bell, the Dow Jones Industrial Average tanked 254 points to 15,660. It had been down about 400 points midday. NASDAQ, which turned positive for a short time, fell 16, and the S&P 500 touched multi-year lows as it dropped 22 points. So when will the selling stop? Those who spend their days on the floor of the New York Stock Exchange say not anytime soon.
I don't think we've hit the worst of it yet, right? I still think that there's a lot of data coming out about the global economy. We've seen data in the U.S. starting to weaken. We've broken some key technical levels, and so now the market's got to find its footing again.
We have global demand problems. We have Latin America in the hole. We have an earnings recession here in the States. We have certain sectors among our 10 S&P sectors that are in outright recession, if not depression. We have problems.
I'm afraid there will be more pressure on assets because there's a good deal of confusion about the policies of the various central banks. The concept of negative interest rates have people very perplexed, and it's beginning to get currencies and money moving around, and that's causing volatility and stress in the market.
But it was oil that played a big role late in the day, helping stocks pare their losses. Despite settling below $27 a barrel at the settlement to a 13-year low, prices came back in electronic trading on reports that the energy minister from the United Arab Emirates, a major player in Mideast production, said OPEC was ready to cooperate on output cuts. Jackie DeAngelis follows the oil market for us. Good evening, Jackie. And how real do you think the possibility of a coordinated cut is?
Good evening to you, Sue. Well, sources are telling me they don't actually think it's very real at all. You have to think about these headlines that we're seeing in context of what's happening with oil prices. We took out a very significant intraday low today, $26.19. That was the low that we hit this year, and it takes us back to lows not seen since May of 2003. What we do know is that global producers are definitely choking on low oil prices, and so some of these headlines that we're going to see are in some ways acts of desperation to try to bid that price up. And today it did in electronic trading regain some of the losses. But also remember, over the last 2 weeks, we've seen this from non-OPEC producers. We've seen Russia talking up an effort like this. We've seen some of the weaker OPEC producers talking it up as well. So maybe there was a little bit more to this today, as you mentioned, because it was coming from the UAE and it was a little bit closer to home. But everybody in the industry is saying it's all about Saudi Arabia. And Saudi Arabia hasn't said anything just yet. So until we hear from them that they're willing to come to the table and negotiate, not just within OPEC, but also with the other non-OPEC producers, that's when we could see some real action. And that is a very difficult effort to coordinate. Also, remember where the Saudis are coming from. At this point, they want to maintain market share. You've got the Iranians coming online, and they're willing to maintain and sit through these low prices.
All right. Jackie DeAngelis. Jackie, thank you very much. Ty?
Well, as nervousness increases on Wall Street, money is flowing out of risky assets like stocks and into the so-called safe haven ones, like treasuries, which saw their prices rise and yields plunge to more than 3-year lows today. There was also a rush into gold, which rose 4.5% today, above $1,200 an ounce, now more than 17% higher for the year. And stocks in the utility sector, which offer higher than average dividend yields, also look more attractive in down markets. But as Bob Pisani tells us, this scramble for safety isn't without risks.
It's the year of the contrarian play. Growth is out, safety is in, dividends are in, bonds are in. Gold is up 17% this year, and it closed at a 52-week high today. Now, they say gold is a hedge against deflation and uncertainty. Remember 5 years ago when gold was supposed to be a hedge against inflation and uncertainty? All right, never mind. When people don't know what's going on, they go out and they buy gold. Now, the downside is gold will fade if we get a clearer picture of the global economy or central banks get even more aggressive. Now, in stocks, the best performing sectors this year are classic defensive names. So utilities and telecom stocks are up 5% this year. AT&T and Verizon are just off 52-week highs. What's wrong with this picture? Well, there's nothing wrong with it, except the prices for these sectors have gone way up. Some of the utilities are trading for 20 times forward earnings. That's pricey for a utility. And remember, you live by low interest rates, you die by low interest rates. For utilities to keep going up, you really have to believe that rates are going to keep going down and that investors are going to keep abandoning the other parts of the market. That's a pretty tall bet. Think about it. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So given their gains, is there more room for utility stocks to run in this market? Let's find out from Dan Eggers. He's Managing Director of Equity Research at Credit Suisse, where he focuses on U.S. power and utilities. Dan, welcome. Good to have you here.
Thank you for having me back.
I mean, that's the baseline question. We have seen money flow into this sector pretty aggressively because of the volatility. Where do you think we are in the overall bullish cycle for utilities?
Notably, the group is up almost 20% against the market, Fed to date, which we referred to when the Fed hiked rates in December. So we've had a very good run. And when you look at the valuations in the sector, it is true, as Bob said, that we are pushing toward historic highs. We're not all the way there. In absolute terms, they're probably 5 to 10% off past peaks. If we look at them against the S&P 500, which is probably more relevant, we are toward the upper bounds of where we've been, but there's still room for these stocks to continue to work. If our colleagues are correct, where they actually see the S&P 500 not really growing earnings in 2016, which is a little more pessimistic than where the consensus views are, you'd look at these stocks looking somewhere in a much more reasonable territory.
How, Dan, do you separate the stocks that you like, where you think there is more room for them to rise, from the stocks that may be a little too high priced and therefore a little more vulnerable? And which ones do you like and why?
Well, that's a great question. So when we look at the stocks, we break up our coverage universe into the regulated utilities, traditional defensive names. We can see some individual stocks where they're trading, in line to their peers. They're a little bit cheap. They're going to offer good growth in that 6% annual rate. They're paying dividends of nearly 4%, and they're going to grow their dividends 4 or 5 or 6% a year. Those are attractive to us. And within those, two stocks in particular, Pinnacle West, which is a Phoenix-based regulated utility servicing customers in Arizona. Good growth, optionality to a housing recovery in Arizona at some point in time. And, one of the big themes in our industry has been consolidation the last year or two. And at some point in time, there's an opportunity probably for Pinnacle West to be one of those very desirable candidates. The other name I'd highlight on the utility side is going to be DTE Energy, based in Michigan. Michigan is a very constructive environment where they're very supportive of utility investment as needed. DTE's been able to grow earnings 6% a year and actually do a little better than that. I think they have the opportunity to exceed their expectations for the next 3, 4, or 5 years, again, trading at a bit of a discount. So that's good quality names that have probably not had quite as much of a run-up as some of the larger stocks have.
All right, Dan, thanks for those ideas. We appreciate it.
Thank you.
Dan Eggers with Credit Suisse.
The sell-off started overseas today. A profit warning from the French bank Société Générale sparked fresh fears about the health of Europe's biggest banks. The group being stung by a trio of concerns: weak economic growth, fear of rising bad debts in their portfolios, and low interest rates. And all this comes as Eurozone finance ministers meet in Brussels, and Julia Chatterley is there.
Eurozone finance ministers just wrapping up their meeting here in Brussels, and I can tell you, never mind what was on the agenda, all the focus here was on what the Eurozone finance ministers make of the current pressure that we're seeing on banking stocks and bonds. And actually the message was pretty consistent. The president of the Eurogroup said to me, look, we're concerned, we're watching it, but at the same time he believes it's far more about what's going on elsewhere in the world and the external pressure that we're seeing on equity markets than it is about being a specific European issue. He said, look, the banks are in a far stronger position today than they were back in 2007. 2007, capital is far higher, and there's all sorts of measures in place that governments and the central bank can enact if they need to stabilise the environment. That was the broader message. And actually, as one commissioner said to me too at the end of this meeting, investors need to have a cold-blooded, rational look once again at the market and at European banking stocks. The question is, will they? For Nightly Business Report, I'm Julia Chatterley in Brussels.
And Sweden's central bank piled on the pressure. It took its main interest rate even deeper into negative territory in an effort to stoke inflation. Policymakers said that decision reflects a stronger economy, but a longer period of low prices. And they say they are ready to cut further if necessary.
Our Federal Reserve Chair Janet Yellen said she would consider negative interest rates if necessary. But during a Senate hearing, she added that the U.S. economy would have to get much worse before the central bank would make such a move.
We would want to be prepared in the event that we needed to add accommodation. We haven't finished that evaluation. We need to consider the U.S. institutional context and whether they would work well here. It's not automatic. There are a number of things to consider. We haven't, so I wouldn't take those off the table, but we would have work to do to judge whether they would be workable here.
Ms. Yellen said she doesn't expect the economy to weaken enough to warrant a cut in rates, let alone to go negative.
So what exactly are negative interest rates? How do they work? And have they ever really been successfully stimulated an economy? Dominic Chu explains.
It's all over the headlines in business and the hallways in Congress. NIRP. It stands for negative interest rate policy. That's where depositors, in effect, pay a bank to hold their money instead of the bank paying the depositor some kind of interest payment. Now, the reason it's getting so much attention is because a number of major central banks around the world have recently adopted this policy because they want banks to lend out money to businesses rather than stash it at the central bank. Now, it's all about that relationship between a central bank like the Fed or European Central Bank and its member banks. Many central banks require that member banks hold a portion of their deposits on reserve. They get paid interest on that money. But banks can also deposit money above and beyond that required amount at the central bank. Those funds are known as excess reserves. These days, many banks are being more conservative and holding excess cash at the central bank. So, central banks are trying to encourage banks to put their deposits to use by charging them to keep funds rather than paying interest on them. That's what a negative interest rate is. And it's new, spreading all across the world. Right now, you've got Denmark, Sweden, Switzerland, and the European Central Bank and Bank of Japan with similar negative interest rate policies. As for whether or not it works, many experts feel it's too early to tell. The world of negative rates has only been around for a few years. Now, it's not in the cards for the U.S. just yet, but just about everyone on Wall Street is watching closely to see if it could become a possibility down the road. For Nightly Business Report, I'm Dominic Chu.
Still ahead, Boeing shares are down 25% this year, and today the stock suffered again, and there were two new reasons why.
A rough day for Boeing. Shares of the aerospace company plunged nearly 7%, easily making it the worst performing stock in the blue chip index. The stock was pressured by reports the Securities and Exchange Commission may be investigating the company's accounting surrounding two of its most popular planes. And it comes one day after a Boeing executive called for job and cost cuts. Phil LeBeau has the story.
Boeing's commercial airplane business is feeling pressure. For starters, the division is about to start cutting jobs so it can stay competitive with its European rival, Airbus. Boeing commercial airplane CEO Ray Conner has told employees they need to cut costs, though exactly how much remains unclear. Then there's the issue of how Boeing handles accounting for its 787 Dreamliner and 747-8 jumbo jet. There are reports the SEC is looking into whether Boeing is accurately projecting the long-term profitability of both planes. Boeing won't comment on a possible SEC investigation, but analysts have long questioned whether the company will ever turn a profit on the Dreamliner, given costly delays when the plane was being developed and first built. In fact, Boeing has racked up more than $28 billion in deferred costs on the plane. Boeing says those costs will be spread out over several years and recovered as it delivers an expected 1,300 Dreamliners. So far, actual orders are short of that total. Boeing expects to start turning a profit on the Dreamliner by the middle of this year. The question is, how much of a profit will it make on each Dreamliner in the future? And is Boeing overestimating future profitability of those planes?
This double whammy of bad news extends what's been a rough start of the year for Boeing. Last month, the company warned that profits in 2016 will be lower than expected due to fewer commercial airplane deliveries. And now Boeing shares are at a level we haven't seen since the summer of 2013. Phil LeBeau, Nightly Business Report, Chicago.
The travel review website TripAdvisor issued a core profit that beat analysts' expectations for the first time since 2013, and that's where we begin Market Focus tonight. Revenue for the quarter also rose, driven higher by display advertising and strong subscription sales. Shares of the company up more than 12% to 61.07 on this down day. Kellogg reported a narrower fourth quarter loss, but still fell short of analysts' estimates. The cereal company did, however, beat profit targets, thanks in part to cost-cutting efforts. Kellogg reaffirmed its outlook for the year and said cereal sales will rise this year. Shares up 4% today to 73.69. The cosmetics company Avon fell today after reporting a drop in sales for the 17th straight quarter, more than 4 years. The company cited weak demand from its Latin American market, which accounts for nearly half of its total revenue. In December, Avon said it was going to sell most of its struggling North American business to the private equity firm Cerberus Capital Management. Shares were punished today, falling 19% to $2.63.
Teva Pharmaceuticals shares were down today after the company reported a drop in quarterly revenue and profit as sales fell in its generic and specialty drug segments. The drug maker announced last July it would buy Allergan's Actavis generics business in a deal valued at over $40 billion. Shares fell 5% to $54.08. Insurance company AIG is adding 2 board seats to avoid a proxy fight with activist investor Carl Icahn. One seat will go to a representative of Icahn's company, the other to hedge fund investor John Paulson. AIG recently announced a restructuring as Icahn pushed for a breakup of that company. AIG also reported a bigger than expected loss, but it increased both its dividend and its share buyback. AIG rose initially in extended hours after losing more than 3.5% today to close at 50.52. Revenue at CBS rose more than 6% thanks to strong numbers from its content, licensing, and distribution. Those 2 areas now account for more than a quarter of the company's revenue. Ad sales were relatively flat in the fourth quarter, which is typically the strongest time of year. Shares initially fell in extended hours following that report, but they closed the regular session up about 1.5% to 43.57. And video game publisher Activision's profit and revenue missed expectations as strong sales of its linchpin Call of Duty game were not enough to offset sluggish holiday sales in its other titles. The company says it expects significantly stronger results this year following its acquisition of mobile game maker King Digital. Shares of Activision got hammered in extended hours after closing up 1% to 30.52.
To politics now. The financial industry has tripled its campaign contributions in this presidential race so far, but doesn't seem to be making much of a difference. Eamon Javers has been following the money. Eamon, welcome. Who tops the list of the Wall Street donations?
Yeah, Tyler, and this will give you the answer to this whole story here. The top recipient here in 2015 for the full year was Jeb Bush, receiving $34.56 million. Also, Hillary Clinton, obviously a Democrat, $17.2 million. And then Ted Cruz in third place at just over $12 million. Those are the biggest recipients for the full year of 2015. That's Wall Street cash going to both the campaigns themselves and to all their associated super PACs and outside groups. The big story here, though, is that when we looked at this with the Center for Responsive Politics, what we found is that Wall Street has more than tripled the contributions that they've made in this presidential cycle to compared to where they were in the same year in the last cycle back in 2011 in the 2012 cycle. The numbers then were $29 million overall. Today, in 2015, it was $102 million. That's a lot of campaign cash coming in from Wall Street employees, executives, and the like, Tyler.
Is that perhaps because of the outlying candidates or those who were perceived to be outlying candidates, Donald Trump and Bernie Sanders, who are now the big winners?
Yeah, look, I mean, a couple of things going on here. One is obviously you have an open seat. Last time around in 2012, you had an incumbent president, so that put a damper on a lot of the campaign contributions. And a lot of the Wall Street money sort of gravitated to Mitt Romney that time. This time we have a lot of candidates out there, and there's an open seat, so there's campaigns in both parties. So that means a lot more money is needed. But when you look at what Wall Street's getting in terms of bang for its buck on these campaign contributions, the two people you just mentioned, Bernie Sanders and Donald Trump, were the winners in New Hampshire earlier this week. They don't even come anywhere near the top 5 of this list of top recipients of Wall Street money. Wall Street is not pumping money to those guys, and they're winning just the same. And then if you look at Hillary Clinton and Jeb Bush, who are at the top of the list, they're not doing so well right now.
And you could say very quickly that Wall Street's getting banged for all those bucks because the candidates are whacking them.
Yeah, Wall Street as an issue is red hot out on the campaign trail, even on the Republican side, and the Republicans are traditionally more friendly to Wall Street and to big business. This year, though, we're seeing Wall Street as an issue on that side, too.
All right, Eamon Javers, thanks very much. Eamon in Washington.
Coming up, Beat the Heat, stocks you may be able to count on to weather this market volatility.
And here's what to watch tomorrow. It will be a big day for the economy. You'll get retail sales, import prices, consumer sentiment, business inventories, all due out. A data nerd's delight. The Department of Transportation releases its report card on air travel. You lose a bag? And the weekly oil rig count could move the energy markets. And that, folks, what to watch Friday.
Morgan Stanley is paying a multi-billion-dollar fine to state and federal authorities related to products sold before the financial crisis. New York Attorney General Eric Schneiderman said the bank will pay $3.2 billion to settle charges that it misled investors on the quality of mortgage loans that it sold.
Well, if you're not sure where to put your money to work in this volatile market, our next guest has some stock suggestions that could help you weather the storm. He's our good friend Mike Holland, chairman of his own money management firm, Holland & Company. Mike, always great to see you. Before we get to your stock picks, I want to ask you just a simple question. Is the bull market dead or dying?
You know, it could well be, Ty. I long ago learned that I can't predict the market. You'll be very surprised to hear that, I'm sure. But it's entirely possible that going into this political season, as you were just describing a second ago, given talk about negative interest rates that Dominic Chu was talking about a little bit earlier, all of these things combined bring about uncertainty. There's a lack of confidence in most things in the world. So is that a possibility as a head start for a bear market? I've lived through a bunch of bear markets. You want to survive them. It's possible. I don't think it's likely, but I'm always prepared. I always have an all-weather portfolio for people myself, and I think it's possible, but I don't think it's likely.
All right. So, Mike, what are the parameters, if you will, of the companies that you would put in this all-weather portfolio? What do they have in common?
Well, so they're the ones that I have most of the time, including in bear markets. I've been through a number of the companies that I would mention. I'm going to mention 7 companies, and each one of them has the same characteristics. They're leaders in their industries. They have incredible balance sheets, fortress-like balance sheets. They are impregnable with respect to financial problems. They are all companies who have the opportunity to sell anywhere in the world, and they actually can grow in a very slow growth environment. So I've got them right here: Chubb, GE, JP Morgan, J&J, 3M, Microsoft, and ExxonMobil. I've owned a number of these in previous bear markets. I'm very glad I didn't sell them. When they get down to where they are now, as this whole group is, because the market's come down 15, 20, 25% for a lot of them, they're yielding 3%. We were talking about negative interest rates a second ago. You got 1.5, 1.7% on treasuries. This is crazy stuff. These are the world's great companies, and they can all and have increased their dividends year after year after year. So it's a kind of a no-brainer to me, because I can go into any asset class I want, go into junk bonds, emerging market debt. This asset class, the world's best companies, their equities yielding 3%, it's a no-brainer.
These are forever stocks, really, is what you're saying, Mike.
You know, Ty, periodically I have to get rid of one or another because managements do screw up. The managements of these 7 companies, however, go back a long time. Over the years, I've gotten rid of IBM and companies like that just because it didn't seem to be working.
Right.
And you have to pay attention every day. It's not that I go to sleep on these companies, but these 7 companies right now look as if they could be okay, even if we're entering a period that might not be so pleasant as the last several years have been.
Let's name them again.
I was just going
go
to say
ahead,
that.
Mike. One more time. Take us through your greatest hits there. All right, go ahead.
They're not greatest hits. They're just examples of companies but it would be Chubb, GE, JP Morgan, J&J, Johnson Johnson, 3M, Microsoft, and ExxonMobil, which might be a little risky for some people. But these are companies I've owned for, most of them I owned in previous bear markets.
All right. Mike Holland, always great to see you. Mike Holland with
Thank you,
Holland
Tom.
and Company. Thank you.
Sue.
And that does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for watching.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everyone. Don't look at your portfolios.
No, not
we'll see you
tonight.
tomorrow. Not tonight.
Maybe tomorrow.